they can sniff out if a company says they're going to go from 0 to 20 million in revenue in 1 year. It's like, well, yeah, well, like what proof points do you have that say you can do that, right? And honestly, it's not usually that egregious. I mean, sometimes it's like they got from 0 to 300K, but then the next year is like 4 million, and you're like, 4 million, like how do you get there? Your average deal size is 10K a deal. That means you have to do, 300 deals. Like what makes me think you're going to do 300 deals to, even get the 3 million, right? So these are the types of things that we can sniff out pretty good. But again, we come at it from a little bit more of that marketing. What is the space doing? And then also that operational expertise. Like,
yo, this is Christian D. Evans with Journey with Christian D. Evans podcast. Guys, thank you so much for tuning in and listening to our amazing podcast. This is where we reveal the top 1% of business concepts and systems and processes to scale 8 and 9 figure businesses. We interview top level 8 and 9 figure CEOs, business owners, and amazing TEDx speakers like David Meltzer. We got Nick Cavuto, Pascal Bachman, and so many others. And if you feel like this resonates with you, please share this with your friend, your family, and make sure you impact them as well, because we're trying to spread the message on those that do not know how to scale 8, 9 figure businesses and talking higher level business concepts. So guys, remember, enjoy the episode and be uncommon if you can. Cheers. Much for tuning into Journey with Christian D. Evans podcast. I'm your host, Christian D. Evans. And guys, we have someone very, very valuable on today. Now, let me just share with you his previous history, and then we're going to dive into what he's got going on now. He was the CRO, Chief Revenue Officer at domain name system leader DYN from 2018 until its acquisition by Oracle in late 2016 for $600 million. Now, while he was there, he spearheaded strategy and go-to-markets to 100 million ARR, annual recurring revenue, 5,000 enterprises, 1 million paid users, 100 million raised, 500 global employees, and 11 executed M&As. Well, do you think you should listen to this guy? You bet you should. Now, right now, he is the co-founder and CEO, managing partner at York.IE, where he sits the vision and leads the vertically integrated strategic growth and investment firm for startups. Now, we are so excited about diving into this because he closely works with entrepreneurs, operators, and investors to help them realize their shared ambition to build good companies, create new jobs, and grow and scale this next level. Please welcome my friend, the one and only Kyle York. How you doing today, Kyle?
Doing great. Thank you so much for having me.
Hey, I'm very excited about diving into this because, like I mentioned, you have an immense amount of experience. I mean, going from DYN to, being able to help with so much going on there. But before we dive into this, you've been able to have a cool, your current company, York.IE investment. Their investment portfolio includes Cyberhaven, Flywheel, HourWork, Metadata, and Vetro. And you were talking a little bit about, before we jumped on this podcast, where you invest kind of more in pre-seed, pre-$2 million kind of revenue, value prop. So I'd love to dive right into it real quick. When you're looking at these companies with your immense experience in this industry, what's the criteria that I just love to get your glasses on, your perspective. When you're looking at a company, what are you looking for when you're saying, hey, this is a good opportunity, this is not? These are the green flags, these are the red flags. What does that look like, Kyle?
Yeah, excellent. Awesome. Great first question. So I think when we evaluate the world and kind of what we built at York.IE, we call ourselves a vertically integrated strategic growth and investment firm focused on startups. Really what we wanted to do is create a resource hub for startups based on where they are in the startup life cycle. A big part of that, clearly, in the earliest stages of company building is capital. And so, whether, you need a little help on marketing, you need some sales help, or you need some financial acumen, companies of all stages are looking for resources, vendors, partners, consultants, hires for that. And we want to create a lot of that, resource hub and resource center. Capital at the earliest stages is where we focus our investments business, and we focus that also on business to business, recurring revenue, software platforms. So we'll work everywhere from like infrastructure, cybersecurity, cloud computing, up into data platforms, up into vertical apps and horizontal apps, as long as it's a recurring revenue business model. Coming from where we came from, DYN was a very focused company on, the internet infrastructure. So we have a deep understanding of that area. So it tends to be an area where we like to invest as well and help support and guide these companies. So, it's pre-revenue to, 2 million run rate Typically, the average customer or investment, is a few hundred K of ARR, annual recurring revenue. So they've got a little bit of product market fit, looking for some fuel on the fire. Typically, these companies are raising anywhere from 2 to 5 million in their seed round, and we're writing right around $1 million to $1.5 million check. It's repeat founders, it's first time founders. We really like tech laggard industries or markets that are sort of ripe for disruption with legacy players in them, or things that haven't been like sort of automated in the same way. But again, a lot of this is on the backs of our operational experience building and scaling and selling companies, and then working at Oracle. At Oracle, they've done over 200 M&As over the last 15, 20 years. We stole a lot of the processes of how to evaluate companies, do due diligence, and try to pick winners relatively. And you said it in the outset. I mean, in our kind of vision of building good companies, I think the venture capital game where we play seed stage venture is really playing more power law. They want to only invest in companies that could be unicorns or decacorns, billion-dollar companies or $10 billion companies. I think we're just a heck of a lot more pragmatic about it. We want to get in the door early on. We want companies to get the good, healthy 25, 50, 100, 200. Hey, maybe they even turn a profit someday types of companies. It's very different than classic venture capital power law. We just want to really help as many entrepreneurs as we can.
Yeah, because you say here on your website, York.IE, where you talk a little bit like what you just mentioned. You kind of focus on the B2B scalable subscription-based revenue models, right? SaaS, up and down the stack, infrastructure, developed tools, cybersecurity platforms, vertical SaaS, up and down the stack. What does that mean exactly in regards to when you're looking at the company? Hey, do they have the infrastructure? Do they have those tools established? Do they have those kind of, all their ducks in the row to be able to say, hey, yes, that's a green flag for me? Is that what you're saying in this regard?
Yeah. So I mean, it starts on the investments business with B2B, right? And then is it software led? And then is it recurring revenue? Is it a subscription model? No different than your Netflix account, right? Is it subscription, but for the B2B market? And then again, up and down the stack starts to look at things like, all right, in your market, if you're a developer tool, or in your market, if you're a SaaS solution for digital health, like who are the competitors, the comparators? So you look at market first. We believe in the market and approach to company building. So understanding your comparators, your competitors, the market size, all of the differentiators that might be being built by your company. We look at the product and the platform. Obviously, this is pretty early at the earliest stage, but understanding what's been executed against so far from a platform technology capability perspective, what's the moat, what's the long-term roadmap, those types of things. We obviously look deeply at the go-to-market, the traction, the customer adoption, what's the sales and marketing strategy, what are the early proof points in that working, hopefully for you, or what's not, and what are you learning? And then lastly, it's team. So it's really those four things. Team, is their founder market fit? Is this team uniquely suited to execute against this vision? And like we said in the pre-discussion, these companies don't have a ton of financial history. They're new, right? So a lot of it is in the projections and again, like the viable path to execute towards those projections, both in a top line as well as in a expense side and path to profitability perspective, right? These are again very immature early companies. So everything you're kind of looking for is how do you de-risk it? It's not like red light, green light. I love the way you framed it, but it's a little bit more like green light and like yellow light. And if it's got a shitload of red lights, sorry to swear, you're probably just not doing the deal, right? So it's really more about like, do we believe this team, these founders, these executives, and their ability to bob and weave, because there's no straight line along the way.
See, and I'm glad you're bringing this up because you mentioned here ripe for disruption, right? And you mentioned this, and I want to unpack this a little bit, even in regards to like the market and understanding the data as well, because like you mentioned, when you're working with a mid-tier, like $1 million to $3 million EBITDA business, right? You know that you have some sort of data, you have some sort of kind of something to pull off of previously within the next 5-7 years and say, okay, hey, I can guarantee and I can also assess my risk from future projections. But in this circumstance, it is very, very contextual and it comes with a lot of experience, right? So you, Kyle, you're looking at the market, and I would love for maybe give us an example, maybe of a case
Yeah.
study of a company that you work with where you were able to assess this, but explain a little bit to our audience the data points that you weighted in your decision to say, hey, yes, because of XYZ, because hey, look at the projection, because of
Yep.
hey, in this data, because the competition was very little. Like what did you look at when you were looking at the projection? Because you don't have the data from the
Yeah.
finances, from the other things of previous like proof of concept. So you're kind of really relying on your own history of
Yeah.
being in this industry for so long.
Yeah, I think, a big thing, if you look at the traditional like private equity, growth equity, venture capital investor, right? Like on the margin, they typically are, a finance background. They maybe worked at an investment bank, or they got an MBA from some, big ticket school, right? And they're many times looking at those financials and pattern mapping to other companies in the space. So looking at different benchmarks, comparators, competitors, but from a financial execution perspective. I think a lot of our backgrounds being more in operating roles, me as a former chief revenue officer, former GM, running marketing, running sales, running business, running strategy. The lens I look at is like, do I believe this company with a good team can execute against their strategy and their vision, right? On the other side of that coin, so that's the functional expertise side of it. Like, do we buy in our diligence process to the operational models of this company and their viability, right? The other side of it's the market expertise, right? That's why you see York.IE do a lot down the stack, as I mentioned earlier. Like we have a deep understanding after 15 years of working in the kind of cloud computing, data platform, database, cybersecurity, developer tools realm, because we were selling and marketing that for so many years. On the other side of the coin, we do a lot for sales and marketing and business tools. So we have a bunch of capabilities, horizontal applications in MarTech, in sales tech, in financial tech, right? So in a bunch of different areas that we used to, or still are, the buyers of those types of solutions. So early on in my, a lot of my investing experience came from my early on angel investing, and I was creating a lot of different vehicles to invest with peers and friends. Part of that was just to write a bigger check and be more influential in the startup community before we launched York.IE. And again, a lot of the understanding of what worked, what didn't, just comes from writing lots of checks and doing it right, and honing your process and honing your evaluation. So, I mean, it really comes down to, again, the functional expertise we have, the market and domain expertise we have. If we don't have market and domain expertise, we make some phone calls and find people who know more than we do about the supply chain industry or the fishing industry or the digital health industry or wherever we might be looking at and evaluating. And then again, it comes back to looking at those areas from market to tech platform to go-to-market traction to team to financial projections. Like, I mean, those 4 or 5 areas, if it's a good tight package and there's some proof points in all of them that it's starting to see the seeds of momentum, those are the types of companies that end up making it through our gauntlet. And Christian, one thing I should say is, I mean, we, York.IE, are engaging with thousands of startups, from pre-revenue to pre-IPO every day across our content channels, our blog, our social, our newsletters. We see about 100 to 125 a month that come to us and raise their hand and say, we're looking for outside capital. And we end up doing about 1 a month, right? So, I mean, that gauntlet, right, to get through, only the best and the brightest that we have our eyes on end up becoming a York.IE investment. Now, the beauty of our model is these companies can also subscribe to our content for free. They can sign up for our Fuel platform, which we'll get to in a minute, for free. They can then get some advisory services or a paid Fuel account. So there's lots of ways to work with York.IE that aren't just capital. But again, a big part of the funnel clearly is companies who are looking for a little bit of juice to get them going.
So what you're basically saying is you don't put too much emphasis on the predictions. You do, but also you rely a lot on York.IE's team, right? Because you guys come in as the advisory team. You guys come in as a service and saying, hey, not only are we giving you some capital, we're investing in this business, but now we are minority or majority owner
Yep.
of this business, and we want to help you scale and grow, and we will leverage our resources and our capabilities to help you get to that next level, and we're very confident in it. So when you're looking at kind of that criteria of a company, you're looking at it as, hey, with the team that I already have in place and the infrastructure that I have with York.IE, can we help this company scale? And that's kind of the way you look at it, more so than, hey, this is yes, it's disruptive. Yes, it's got a value prop. Yes, it's got proof of concept, but also you kind of relying a little bit heavier on your expertise. Is that correct? Just so
Yeah.
I understand.
Yeah, no, I think so. I mean, I think the reality is like there's a myriad of ways for a company that we invest in or not to leverage our skill sets, capacity, understanding, resources, infrastructure. Not every investment needs to go set up a retainer and get a few of our advisory modules for Mercom or for development, right? They might have some of those things already set, right? Sometimes we work with companies and invest in them, and 2 years later they call and say, hey, we want to do a big analyst push, can you help us with industry analyst relations, right? So at the end of the day, I think no matter what, we are the most value add investor there is just by being an investor. But we also have this resource center from our data platform Fuel all the way to our advisory services suite that companies can leverage. I think the other side of the coin is a really good one too. Like, we have over 75 advisory services engagements. So these are companies that come to us that might be, 50 million a run rate already and a few million of EBITDA, or have already raised $20 million and aren't early stage looking for money, or just raised a big round and just need help. And so we've basically created this ability to work with not just the portfolio of investments, but also any company who's looking for scaling help and wants the expertise. And there's actually, I think we're up to, as of today, 70 employees globally who are building that infrastructure from that tech platform through that service capability.
Wow, that's really, really remarkable to see kind of the value add that you have. You're very, very active in that stage and focus, right? I think a lot of investors I see more passive, where
Yeah.
they can write a check, cool, wonderful, but I think that extra value add is what really allows you to stand above, and that's the reason why you've been able to achieve the higher success that you've been
That's
able to achieve.
especially too, Christian, especially true at the earliest stages, right? If you think of like pre-seed, seed stage, a lot of times it's friends and family, it's your rich uncle, it's your doctor, sometimes if it's a small fund, they're typically an angel group or a small fund. They don't have resources at their disposal. They're not also building a company that can help you with growth, right? So I think it's just the nature of the stage being a more passive stage. So if we can be active capital, smart capital at that stage, it's really important. I also think like there are investors, bigger investors that bring resources. When you get to like Bain and Warburg and Sequoia and Andreessen Horowitz and these big names, they have a lot of resources, but they only leverage those resources for their investments. I think a unique part about what we're doing is, we're building like a modern McKinsey meets BCG, that also meets Gartner, that also like has a capital pool, but can help you at any stage of growth with capability. And again, that's a sort of inversion of what you said about investors. It's also true for the management consulting, for the services industry. I don't think they're able to downscope and move fast and integrated and urgent and low cost for the startup space because they're chasing Fortune 500s or Global 2000 companies with their business models, right, which are typically hourly billable and chasing the dollar. I think we can be flexible. Many times when we have an advisory engagement, we have a monthly retainer for whatever service capabilities they have, but sometimes we'll even negotiate in some stock options or some stock position to keep the costs low, and so that we can align incentives long-term on that side of the model. So again, super flexible, fluid, sort of built for anyone. If you're a private company in technology, we can help you.
So let me ask you this in regards to when you write a $500,000, 1.5 million kind of check, and you take an equity position in this. How do you, because I have my own criteria and what I like to see that founder deploy that capital. There are certain things that I know that's probably going to get a better return depending upon obviously the context of the company and where they're at in that stage. But what do you and York.IE, what do you guys like to look at in regards to, okay, hey, when I give you X amount of dollars, this is what I would recommend deploying that capital. What would you recommend? What does that look like?
Yeah, so it's interesting. I think it's a little bit on a spectrum. So in probably 2/3 of our deals, we're the lead investor, which what I mean by that is we're dropping the term sheet, we're negotiating the legal docs, we're taking a board seat. We're much more actively involved from a governance perspective to sort of like approve the financial models and the budget. And then other third of deals, we're just a participant. We're kind of relying on some other lead investor to be a little bit more active in evaluating your question, which is where's the hard fundraised dollars going to prove an ROI. Typically for companies, we're very KPI focused. So what I mean by that is we're looking at key performance indicators that help the company achieve milestones to get to the next level, whether the next level be profitability and sustainability, whether the next level be a new fundraise, or the next level be a new revenue milestone, or customer count, or a platform announcement, or international expansion, or cross-vertical expansion. So we're always looking for like, what are the things that unlock the next phase of opportunity for the company? Now, I think what's tricky in the early stage space is the capital is typically relatively limited for the market opportunity these companies are chasing. So I think we veer a lot towards like, pragmatic, sales and marketing investment. Like what, are you putting towards marketing programs budgets? What are you putting towards sales headcount and hiring? And obviously it's got to be balanced. It can't all go there and then no R&D investment or no, back office investment, right? So I think we look for the balance, and we look to make sure that the investments in different areas are for an outcome of some sort of KPI or milestone reach. And and also a big part of it, to be honest, Christian, is like making sure we believe it. I mean, I can't tell you the amount of fundraising decks I review, or my team reviews. We've got a team of 7 people who all they do is review investments for us. And I trust this team, and like they can sniff out if a company says they're going to go from 0 to 20 million in revenue in 1 year. It's like, well, like what proof points do you have that say you can do that, right? And honestly, it's not usually that egregious. I mean, sometimes it's like they got from 0 to 300K, but then the next year is like 4 million, and you're like, 4 million, like how do you get there? Your average deal size is 10K a deal. That means you have to do, 300 deals. Like what makes me think you're going to do 300 deals to, even get to 3 million, right? So these are the types of things that we can sniff out pretty good. But again, we come at it from a little bit more of that market in, what is the space doing? And then also that operational expertise, like, we want companies to be successful, right? Like we don't want them to just put pie in the sky numbers out there if we don't believe it. Earlier, you would ask me a more specific question to use an example. One example I want to use is Metadata.io. You mentioned them earlier. They're really hitting the cover off the ball from a growth perspective. They're a MarTech company that's automating B2B digital ad spend. So think about the advertising you see on LinkedIn or on Google. If you're looking for a new solution in your space for sales automation, or for a CRM or a marketing automation or what have you. These guys are selling B2B companies a lot of automation so that they can manage their programs. So in that business, we saw some initial traction. We saw a great team. We saw a really clear product and product roadmap. We also saw that the capital was going to be able to unlock next phase of growth milestones pretty easily based on the foundation of their go-to-market and their lighthouse customers. So there's a lot of these things kind of together. And again, then they executed, right? I mean, that's the thing we don't always know is like how well they can execute when it doesn't go their way, or once they have the cash in the bank, they're going to rest on their laurels, or are they going to double down? And that's just a good example of a company that I think they've had 2 or 3 fundraisings after, and they're valued in the hundreds of millions of dollars now. And it's a great story for the York.IE model, because we also leaned in a lot. We still do work with them on Marcom and go-to-market advisory. So it's a really, really good example of this hybrid model, and some of the things we looked at that have proved out, thankfully, since the investment.
Yeah, so it's always a context, and that's with really anything. It just all depends by looking at something. That's why I wanted to kind of unpack that. So I appreciate giving me that case study, because I've looked at some companies and I found it always interesting. You're exactly right. Where, hey, we give X amount of dollars, right? We we write a $1 million check, cool. But then all of a sudden they say, hey, we're going to go ahead and implement it into sales, marketing. To me, I'm very reluctant, definitely in the SaaS world, doing any R&D, because what I've noticed sometimes is that is not, because in the SaaS specifically, we're talking about this industry, the major KPI, the valuation to get the multiples is off the ARR. Is that correct?
Yep. Yeah, it is. It's ARR, like scale plus growth rate. So like prior year to now growth rate. I think gross margin in SaaS, they're always north of like 60%, could be up to 80, 85% gross margin. Operating margin, EBITDA is usually underwater because they're investing in that growth, right? I think the thing with R&D is, the product needs to work and it needs to deliver on the promise that you're marketing and selling to the world. So I think it's just a balance. There needs to be R&D investment, but you don't want to get too far ahead of your ski tips or let one customer pull you in some product direction that isn't for the masses or repeatable for all customers. So there still needs to be like really solid R&D investment. The other thing that you got to remember is most software companies are founded, the founder CEO is typically an engineer, right? I mean, you and I can't code a lick. I don't think you can, no offense. I certainly can't. So, again, most B2B software companies, I don't know what the percentages are, but they're going to be a founder CEO who's an engineering product background. Many times there is a business guy or gal, alongside a technical co-founder. That does happen too, but a lot of the early investment does tend to be really product heavy based on the expertise and experience of those founders. The other thing is most companies, we call it the product out approach to company building. As you've heard me say twice now, we talk about the market in approach to company building. That's understanding the market, the comparators, the competitors, the market size, the total addressable market, the service addressable market, and then being able to build a bottoms up financial plan of how you're going to execute against it. Engineering founders tend to build a product out strategy, which is, I know I can build this and I can innovate on this and it can have a lot of differentiation. And I'm going to go then test it with customers in the market and try to be disruptive. Again, both ways have proven over history to work. It's just, we feel uniquely capable to help on the market in approach and then make sure there's sound business practices to get there.
Now you were mentioning here, and I want to loop back around in regards to the data that you're bringing in, right? You use your proprietary method, Fuel, and I'd love for you to just talk a little bit about that, because that is actually very accessible for those that may be listening, that are either active investors or private equity or whatever, to get access to kind of this data. And you mentioned offline that's very similar to Crunchbase, so I thought that was kind of a good context a little bit in regards to. But if you could just share with us kind of what that Fuel is. And then as well as if you could explain kind of what you look at, again, kind of when you're looking at a deal.
Yeah, for sure. So from a York.IE perspective, the way to think about us is our operating business is a SaaS plus advisory business model, right? So SaaS being Fuel, advisory being services from Marcom, go-to-market, business growth, and product development. Okay, so we have these four capacities. If you look at York.IE end to end, then plus capital is the sort of thing that enables us to double down, deeply and entrench ourselves in companies by, being preferred shareholders on the cap table, right? It's a very different relationship than just somebody who buys a product or somebody who buys a service from us. So the reason I re-outline that for you is Fuel, our data platform. Think of it like you mentioned, like a Crunchbase, but it's a much more operational lens of a Crunchbase. What I mean by that is it's a private company database where you can log in, you can look yourself up, you can look your competitors, your comparators up. You can then look up different markets or industries. So say you're a cyber company, you can go look up all different cyber companies. You can see the leadership, the PR announcements, the blogs and content, the social media followings, and you can do research across your industry leveraging this platform. You can then go create watch lists. You can track these watch lists. They can show up in your newsletter. It's got a mobile app and a browser app and a desktop app that you can leverage for it. So think of it as the shortcut, fast track solution to do market competitive intelligence, follow the trends, and deeply understand your industry. The way I always talk about this is being the most prepared person in the room, right? If you had a Fuel account, you would have looked up York.IE and all our competitors and comparators on that, Instead, you're running around going to LinkedIn, you're going to my website, you may be going to Crunchbase, you may be going to Owler, you're going to Twitter. We've consolidated all that to short circuit your ability to do research quicker. Doesn't mean you don't jump off to those areas, by the way, for deep dives, but it's a hack to try to do market and competitive intelligence faster. So that's the Fuel platform. And the beauty of it is that tech enables everything we do for York.IE. So all of our services have templates and different playbooks and methodologies that are all actually available for download, self-service for customers who just want to leverage the Fuel platform. We use these services this platform, the data, the automation, the playbooks, to automate and be more efficient in how we deliver advisory services for all of our customers. Same goes for the investments business, right? I mean, when we do discovery or DD or market tracking or investor relations, we leverage our own data platform to automate a lot of that work and to keep it super integrated and collaborative. So think of Fuel as our own, enablement platform for everything we do to automate, make us efficient, make us differentiated. But we also have opened that up for the market so people can get a free account, a paid account, a team account, an enterprise account to get the same sort of magic and marketed approach to company building that York.IE offers. Because if you think about it from everything we've talked about today, from like, if we're an investor and we're on your board, we're kind of in your shorts, right? When we're governing your company, we want to be able to have abilities to work with companies all the way from like the most hands-on governance all the way to no touch, low touch. And that starts again with going to our blog, signing up for our newsletter, following us on social, listening to this podcast, all the way then from like, okay, next layer down is get a free account on Fuel. Next layer, get a paid account on Fuel, all the way through to advisory, all the way through to investment, right? So it really is an engagement. We call it the engagement matrix. And with every startup we engage with, we can kind of plot them on our matrix of low touch to super high touch.
This is really remarkable. And I know you mentioned here with some of your services that, and I want to kind of loop into this here real quick, and growth strategy a little bit in regards to the acquisition channel specifically, right? I know it's all dependent, again, it's context dependent upon obviously that a company. But what determines if you're going to go through the acquisition model compared to just, hey, you know what, let's take some of this money, let's shove it back into the sales marketing, and let's just get ARR up and growth rate and whatever. Well, what does that look like?
Yeah, I mean, I call that the go-to-market motion, right? It's like, what is your go-to-market motion for your company, right? Many times companies try to do it all from the beginning. So whether that's the product-led growth e-commerce model, come to the website with a credit card and buy, to the enterprise field motion, to the inside sales, go-to-market motion, all the way out to the channel, distributors, resellers. The problem I see too often early is that too many companies are trying to do all go-to-market motions. They think that that's what they need to do in the year 2022. The other problem I see a lot is companies overly reliant on someone else selling for them. So the channel, it's until you can prove your own customer acquisition strategy, how do you expect to enable and support a partner to sell for you, right? That typically comes a little bit later. So a lot of this really has to do with, again, that marketing approach to company building. It's, what is the market doing? Who are you trying to disrupt? Who are you competing with? How do they buy? What are the price points of the product and capability? And then that kind of works its way back to what go-to-market motion you should have. If it's a $50 a year product, it probably needs to be e-commerce. It's going to be too expensive to sell that with a sales rep. If it's a $20K a year product, I probably wouldn't go field sales where those guys and gals cost you 300 to 500K all in comp to sell a 20K product. Usually that's an inside sales BDR, account executive, inside sales motion. So a lot of it really anchors around that marketing approach, pricing, packaging strategy. Because if you think about how do I hit a number, right? Let's say I need to do $1 million ARR next year. It's like, well, what's your average deal size? And then how many deals you need to win across the year to hit $1 million ARR, right? It gets kind of like that bottoms up modeling needs to attach to that go-to-market strategy, needs to attach to that market.
Yeah, I wanted to ask that because I think it's so interesting. I see so many companies, even if they're doing about 2-3 million, top line, and it's just like they have all these different strategies, but they haven't turned them full 100% on, right? Maybe they're got one acquisition channel and it's slightly rock and rolling, but it's not like 100% capacity. And I just find it so interesting where, like you were mentioning, Kyle, where they get another idea or another advisory and it's like, oh, let's add this other channel. And I just wanted to make sure that obviously when there's that growth focus, hey, there are focus on what's already working.
Typically it's
Turn
the
that dial.
engine, right? It's the engine,
Yeah.
turn the dial, scale the engine, like I think as you grow, you want to have different distribution channels or acquisition strategies to diversify. But I mean, it's really about what's the fundamental repeatable engine. It's a reason why I like vertical apps. So like, an app selling the pest management space, or an app selling, at home, services industry, or, right? Like I like these because they're, what I call it is point and shoot, right? You can create a list of who you're selling to, you can call them and you can sell them, right? A lot of times cloud computing down the stack stuff or horizontal applications who can sell any company, it ends up being hard for them to figure out where to start and where to focus, right? So I think a lot of that strategy of like market segmentation, verticals, buyer personas, all the way through is something that just not enough companies put a lot of mind share in. They kind of just like throw spaghetti at the wall, see what fits, and to your point, end up with sort of a scattered and no identity go-to-market effort.
So when you're looking at the growth, I know one of the biggest things is to make sure that everything with the SaaS is a subscription model.
Yep.
And what I've noticed is a lot of companies naturally, right, larger companies who want to get into the enterprise. One, because you need fewer deals to get higher revenue naturally, right? And we get that. And plus they tend to be a little bit more consistent and the churn is not as bad, right? Compared to obviously when you're talking smaller numbers. Kyle, is it just dependent upon each business and structure, or do you just as an advisory team as York.IE come in and say, hey, naturally our evolution is going to be going over to enterprise deals and we want to find a path and a strategy to get there, or is it more of like contextual? Hey, if this is working, the smaller deals, right, lower, more quantity subscription, let's rock and roll and just anticipate kind of a relatively higher churn? Or do you always want to go toward that enterprise?
I mean, I have tweeted about this. I have blogged about this. I've sat in a lot of growth stage boards as an independent board member. I've sat in boardrooms for my past company, Dine. It seems that a lot of all like private equity, growth equity, later stage investors who tend to be financial investors. These firms are more like banks than they are operational support. All say go enterprise. Like, why don't you have more $1 million deals, or why don't you have more $500,000 deals? Because outside in, and you're looking at a financial model, it looks like the easiest way to get to some level of giant scale or financial return for an investor. It couldn't be more peanut butter to think that way and have that approach to how companies grow. In my company, Dine, for example, we got to 100 million ARR, 25 million was on $50 a year accounts. We also, the majority of our company, call it 50 million of our revenue, came from an average of 18K ARR. So that's what we would sell through our inside sales motion to a mid-sized company or startup smaller businesses. We did have $1 million accounts, but even in that model, I think this day and age, you're seeing a lot more land and expand to get there. It's like, can you bag the $1 million account right now, or can you win a 50K deal that becomes a 200K account, that becomes a 500K account, that becomes $1 million over a period of time? So again, that's a very different motion than hiring people to go sell $1 million deal right this minute. So I think it's all comes down to, again, that market and approach. Like, what's the market demand? Who are you up against? What do those solutions cost? How mature is your solution? What's the consumption model? So you mentioned subscription. I mean, subscription is typically based on some sort of usage or consumption or seats or or packaging or what have you. And so where does your entry point make sense? And what can it expand to? It all needs to be kind of validated, right? So these are the types of things. I think every company, honestly, is unique. There are companies, by the way, that do start out and sell a $500,000 deal, but guess what? They're probably building back to the R&D thing, for like 4 or 5 years in stealth mode, right? It's so you know, I think it's all company specific. And again, choosing the right go-to-market motion for you is very dependent on the market and is very dependent on your price points.
I appreciate you kind of sharing that context a little bit and that perspective, because it's interesting, like you're mentioning, you know, kind of that evolution of the client itself. Hey, would, you know, and I think that's a really good example, what you just mentioned. Out of the 100 million ARR that you had, 25 million was coming from $50 accounts.
Yeah.
And another 25, maybe 50 million was coming from 50K accounts, or 18K, I think is what you
Yeah,
mentioned.
yeah,
So
18K.
really, yeah.
Yeah, and I mean, the way I kind of talk about it is like, I don't know if you've ever seen the image where it's like elephants or whales, like deer, rabbits, right? And then mice. And it's like, how, you know, it's like the number you need to get to 100 million ARR. And, you know, again, that's kind of like, put that in a pie chart and spread it out, like figure out what your repeatable engine is and how you're going to get there, what go-to-market motion supports that. And heck, I'd love it if you won $2, $3, $4 million accounts too on your path there. But that also proves a lot of unpredictability. Another thing we see is many times, like the giant deals can be like massive outliers to the go-to-market. Got super lucky in some way, or some great sales rep bagged the deal. But sometimes you can end up with like gross revenue concentration. You know, there's a company that we work with very closely that half their revenue comes from one account. And that's a scary world, right? Because if that account goes away, then your revenue just got halved. Right. So everything that company works on now is to not revenue concentrate the other half, right? To have as much diversity and fluidity and have some accounts that emerge from that become giant accounts too. So you lose that sort of risk of revenue concentration. Again, the one thing I'd like to just make sure is clear is, like, as much as we at York.IE have this growth philosophy and have, like I mentioned earlier, playbooks and templates and methodologies, no two companies are the same, like no two, right? So it really does come back to that nuance, that context, that trend spotting, you know, leveraging our Fuel platform, getting deeply into the models of what's working and what's not with companies to help them get to the next stage.
I love it. I love it. Now I want to talk about the kind of a little bit of back end here, the exit. What is your guys' strategy long term at York.IE? Do you guys look more like a secondary position, looking to get acquired at some point and then take it out, or, you know, IPO? What is that like?
Yeah, I mean, I think in B2B SaaS, especially any company that raises outside money, I mean, the moment you raise outside money is the moment you say, we're not you know, going to build a lifestyle business or even a 3 to 5 million EBITDA business that spits out dividends, right? Like, the moment you take outside money, it's all about enterprise value creation and how do I step level my valuation for some inevitable monetization of the asset, the company. The company truly becomes an asset at that point. So from our perspective, there will be typically other funding rounds that exist after us. In many of those situations, those new investors are trying to buy out old investors and put money on the balance sheet to help the company grow. So I think from our view is the startup investing game is a long game. It's a 7 to 10 year journey. Companies don't, you know, build and succeed overnight. When I joined Dyn in 2008 till we sold it in late 2016, it went from 3 to 100 million, right? It was not worth 600 million at the time I got there. We had to go create enterprise value and make it so, right? So what we look at is really what I call the preservation of optionality along the way. We want companies to do smart funding rounds, to invest appropriately in their go-to-market, their R&D, their business operations, build healthy, scalable, sustainable business models. And if along the way, a big investor or strategic acquirer or an IPO opportunity opens up, you're poised and in a position to tackle that, right? Those are good problems to have. Along the way in building Dyn, we got 5, 6, 7, 8 acquisition offers along the way, and we evaluate each one very seriously and said thanks, but no thanks. And thank God we did, because we ended up monetizing the asset for a far bigger number, right? So we try to coach our founders, coach our executive teams, help them make thoughtful decisions along the way, understand the time value of money, and realize that we want to be putting wins in the win column, right? That's not a traditional venture capital model. What I mean by that is, you hear 9 of 10 startups fail. It's like, well, in the traditional venture capital model, that might be true, where one company carries the success of a fund, and 9 might fail. In our model, we want 9 of 10 to succeed, right? And that might be a bunt single in the first base, like sliding in, selling for right. It might be, hey, you made it and you IPO'd, now you're worth $3 billion, and everything in between. And when they fail, we don't want that to be because of lack of capital or funding stacks or those types of things. We want it to be, okay, hey, it just didn't work. We couldn't figure out product market fit. We couldn't get out of the blocks. We couldn't get scaling. That's going to happen, right? And that's okay. There's tons of learnings from the failures, but it's about putting wins in the win column relatively, right? So we're never looking to sell our positions. We want to, ride with the founders as long as they can go and as big as they can get it. But we're very, very thoughtful and aware that a good exit for a founder needs to marry with a good exit for an investor, and we make sure to help coach along the way.
This is such a good conversation, man. I appreciate you just unpacking at a very, very deep level for our audience, for myself. I've been taking so many notes, and just kind of like you mentioned, when you're looking at the company, the criteria, definitely pre-seed or whatever that looks like, as well as, you're unpacking the founder, you're unpacking the market fit, the value prop, and the proof of concept, but also on the back end, long-term, you're coming alongside with your team, York.IE, and your advisor and your consulting and your resources and your skill set, to be able to help them grow and have that growth trajectory.
And we have a ton of experience on the fundraising side. We've raised a lot of money for ourselves and for our companies. We also have a ton of experience on the M&A side. We've bought and sold lots of companies. So we have a great Rolodex and network to do business development and corporate development and help with that execution. And I think that's the thing, right? It's from day zero monetization, like how do I win my first account, to inevitable monetization if I'm selling my company or going public. We've got sort of experience end to end. And I think that's something that operators really need. They need just a coach. They need someone to help them think through personal finances, to think through mental health, to think through team building and culture, to think through work-life balance. Like it's not all dollars and cents, right? I mean, this shit's really hard, and you need to feel like you have a resource center that's a warm blanket around you to make you feel better on the journey, because it's no straight line. I love those like diagrams of the startup like life cycle, and it's just a mess, right? The other thing, Christian, while you were talking, it made me think about is I also think companies need to get off this vanity treadmill of TechCrunch headlines and Business Insider headlines, and you don't have to raise outside money, right? And the majority of companies should never raise $1 of outside money. You'd be better off, asking your parents for a loan or going to your local bank. Owning and running a company is hard enough by itself. The moment you bring in outside stakeholders, you better be prepared that now you're trying to build something of growth that is going to need to have an exit event, right? People don't just invest for the altruism of it; they're investing to invest for a return, right? So just be sure if you're raising money, you understand what that means and what the expectations are around that capital. And who, if it's personal people versus true funds, it's just a big different game. And I know tons of founders who have sold companies for single-digit millions or 10 million or 20 million who didn't raise outside money and kept all those proceeds for themselves and their team. And again, those are some of the most successful people I see in my town, in my communities that I run into on the internet here. It's not all, you don't have to be a unicorn. You do not have to be worth hundreds of millions of dollars. Like, you can be really, really successful building something in your control. Again, I just think people need to remember that in this world of like fundraising and TechCrunch headlines.
That is a very good perspective, and I appreciate sharing that with our audience. Kyle, again, I appreciate your time today and just unpacking this. I just love your just being able to tap into that brain, that perspective when you're looking at these deals and structuring. Like you mentioned, you have immense opportunity in regards to resources, the M&A aspect, as well as just the ecosystem of other investors to raising capital for these companies. Kyle, if some of my audience wants to reach out and learn more about what you got going on and understanding what your ecosystem, how can they reach out to you, my man?
Yeah, sure. Yeah. So I'm at personally, I'm at KYork20 on all social media channels. You can find me KYork20. 20 is my football, my old football number. I formerly played college football. And just, that's my lucky number. York.IE is York.IE is our website, and we're York Growth across all social channels. On our website, there's ebooks, there's case studies, there's our newsletter, our strategic growth newsletter. There's loads of free capabilities. Also sign up for a free fuel account. There's a million ways to engage with us, and honestly, we've created this company to make an impact and help inspire and educate and coach founders of all types in all different industries. So hopefully you find our resources compelling and you'll engage with us across those channels.
Yeah, guys, for those that are listening, those links will be in the description below. And York.IE has an immense amount of resources there. So I'm going to go ahead and put that down there as well. And his LinkedIn account and everything also. But they do have a ton of case studies, but also what they've been able to do, the growth trajectory, and then also tons of resources. So again, Kyle, I appreciate your time today and having this amazing conversation. And I always love to ask my guests before I let you go fully, is there any last words of wisdom they'd like to share with our audience?
Well, I think just have fun and keep that perspective along the way. I think I know how hard it is to run and scale a company. I have a company doing that with hundreds of companies. And it's important to also take a breath. It was nice to just have a long weekend here in the States, and really enjoy it. I know it's Canadian Thanksgiving and Diwali's coming up in India, and there's just make sure to unplug too and have that balance in your life and have fun. And hopefully your career and your startup and your job is also your passion and your hobby, and you really enjoy it too, because it's hard. And if you don't, it's even harder. So I wish you all the best out there.
Guys, that is amazing wisdom from my friend, the one and only co-founder and CEO of York.IE, Kyle York. Guys, that is Journey with Christian D. Evans podcast. Until next time, be uncommon if you can. Yo, this is Christian D. Evans, Journey with Christian D. Evans podcast. We thank you so much for listening to this amazing episode. If you feel and you know that this was valuable to you, please show some love to our amazing guest by liking this, by commenting on this, by making sure that you do a nice 5-star review and just show some love to our guest. That'd be really awesome. Also, make sure you share this with a friend, a family, a colleague, someone that you believe would bring value to their life right now. And guys, we just want to say thank you again for just being part of our community. If you want to have more resources, don't be afraid. Go to christiandevans.com. You can actually schedule a phone call with me, or you can send me an email at christian.evans@beUncommonIfYouCan.com. That's christian.evans@beUncommonIfYouCan.com. Always love to hear some feedback and let me know what is the number 1 or 2 things that you are struggling in your business and your life, and we'll make sure we have those conversations. Guys, that is Journey with Christian D. Evans podcast, and until next time, remember, be uncommon if you can. Cheers.